So this is a really good lecture to end on. A lot of times students have don't know a lot about credit and credit cards, and so they have a really big question. It's like, why do I need to establish credit? Um, do I need a credit card? And if so, what types and how do I use it? Well, that's what this lecture is all about. So we're going to talk about the need to establish credit. Then we're going to talk about how you would do it, and what types of things go into your credit score. Lastly, we'll talk about the types of credit cards and types of credit you can get into, credit cards or revolving lines of interest. And we'll talk about how interest charges are computed on credit. So, when we think about credit cards, if you're going to take one out, what purpose should it serve? Well, the first thing you should think about is credit cards are small balance loans, but they are on demand loans. So you don't have to go fill out a loan every time you want to go buy a sandwich with your credit card. However, you shouldn't really be using them for sandwiches. Your credit card should be used for a few things. First of all, establishing credit worthiness for larger loan qualifications. You're proving to lenders that you can make payments. And so when you charge something, you pay it off. You charge something, you pay it off. Doing that over time is going to show, let's say, a mortgage lender that you're responsible enough to handle a large mortgage loan. Additionally, you might use it to obtain expensive necessities. This means you are going to pay interest, right? You can't pay off the loan balance all at once. However, a small little credit line from a furniture store might allow you to get furniture when your house is completely empty. Um, I remember when I had the next bullet, a financial emergency. I had just arrived back to graduate school at Tennessee in Knoxville from a trip to see family in Louisville, Kentucky. And when I turned off the interstate, my car was falling apart. Literally, the wheels were coming off. And so I managed to grind it into a repair shop. And I was in grad school. I didn't have the money. They had a line of credit that they offered from the repair shop. Now, it wasn't the best interest rate, but it did get me through, got my car back, and I was able to pay it off quickly. Um, and so I needed that line of credit there for that financial emergency. Um, Nowadays, of course, I have an emergency fund, and we talked about saving for that type of budgeting for that type of emergency. The last thing people might use a credit card for is ease or convenience. Um, let's say you're traveling and you're going to be spending a lot of money, and you want comfort and ease, and you're just going to swipe your card, but you're going to pay it off all at the end. That's fine. But how people get into trouble is when they start using their credit card too much. So they start paying for basic living expenses, or they go out shopping and they find something that they think they just need, and so they swipe a card and buy it. Like, you have to have Xbox in the next version of FIFA, so you just charge it and don't worry about how that fits into your budget. Or you're buying non-durable goods and services like food with it. A rule of thumb is that if you're going to buy something on credit, the good you buy should outlive your payments. Um, and that's to keep you from committing yourself to future payments that aren't a part of your budget. Um, so we want to focus on these things over here on the left. And what we're going to look at a lot today is the establishment of credit worthiness through credit, through using credit to prove to lenders that you're credit worthy. So, why is credit worthiness important? Well, lenders require borrowers to have good credit worthiness. And so you may have heard of something like a credit score, and we're going to look at this credit score, but it ranges from around 300 to 850. And you'll notice that this is internal data from LendingTree on the rates they were able to approve people for car loans and their credit scores. And so what you notice is somebody that has close to an excellent credit score gets super low interest rates on their auto loan, whereas somebody who even has a poor one has a 14.5% interest rate. Guys, this is a credit card. Auto loans, we want to be down here. This is a huge interest payment for an auto loan. So you really want to establish good credit scores to get really favorable rates on purchases. How do you do that? Well, let's peel this off layer by layer. When lenders are deciding to lend to you, they start to conduct a credit investigation. And that's just like it's how it sounds. One part of this investigation is we're going to require an application where you're going to supply your age, income, lifestyle, employment, lots of other information on your own. The second thing, and this is the important thing, is that lenders are going to receive a credit bureau report. And so, what credit bureaus are agencies that collect your payment data. So, every time you took out a small credit from a clothing store or took out a credit card from your bank and you made payments on it, these are all getting recorded in the credit bureau report. And so, these local commitments, say you go to the local mall and you have a credit card at Belk, get all sent to these big three companies, Equifax, Experian, and TransUnion. And they compile this data so that everywhere you go in the nation, you can have a credit report run on you by any company. Um, these reports are quite involved and they help lenders decide whether or not to give you a loan and what type of rate to qualify you for. You, as the consumer, are entitled to see your report once a year for free by going to this website. So, what does a credit bureau report look like? Well, here's the top half. It has your personal data so that you can be identified. It has all previous addresses so that they can attach you to previous payments and collections and issues in your credit history. It has your employment history so they can verify how long you've been working and at what places. This is going to be important for qualifying you for a loan because they want to show that you've had a history of employment and you're not likely to, be fired or have gaps in employment. Credit agencies have access to your public records. Bankruptcy is public. Liens on your on your assets are on file. Foreclosures are on file. And then if you ever were so delinquent on your bill payments that you had to be sent to a collections agency, that's going to be on file. Additionally, they have information on all of your credit accounts, and this is where building credit becomes really important. So this person actually has terrible credit history. They have this credit line at AmeriCredit Financial Services. It was an installment loan. It appears for an automobile, $16,000. But in that time, they were delinquent 30 days 7 times and 60 days 5 times, and the car was repossessed. They have a Capital One credit card. They were delinquent 2 times 30 days and 1 time 60 days. And then down here in their Federal Credit Union revolving line of credit, they were also past due. And so companies use this information to make decisions on whether to lend to you or not. So how is all of this information consolidated by companies? Well, the credit bureaus create credit scores. And so you may have heard of these before. And the first one is FICO, Fair Isaac and Company's credit rating. And this is very popular. FICO scores range from 300 to 850. And there are generally 5 elements. I shouldn't say generally. There are 5 elements that feed into the FICO score. Here's what they are, and here are their weights. The 2 most important are your payment history and the amounts that you. Let me correct this. Amounts owed. Your payment history and your amounts owed. If you have a strong payment history with no late payments, that's going to factor in heavily to a high score. If you don't have a lot of debt, right? You're pretty solvent. You don't have a lot of liabilities, then that's going to factor heavily into your score. To a lesser extent, the length of credit history. So obviously, if you just opened an account, you're going to have a good payment history and good amounts owed because everything is going to be pretty fresh and new. But the longer you have these good histories, the better. And then they're going to look at how you're doing on your newest types of credit and what types of credit you hold, whether they are, credit lines at predatory used car dealerships, or where are these credit lines coming from? What types are they? Another type of score is the Vantage score. These are created by the big 3 companies that we talked about: Equifax, Experian, and TransUnion. They incorporate data from all 3 of the bureaus, and they create a score as well that companies can use. The last thing to pay attention to is the debt safety ratio. So regardless of how well you're doing on your payments, lenders are not interested in putting you in financial stress. And so the ratio of your monthly consumer credit payments to your monthly take-home pay will never be allowed to exceed 20%. In most cases, companies are even more strict at 10% or 15%. than this 20%. But the idea is, let's say you take home $1,000 a month. That's after taxes. This means that with that ratio of 20%, they're only going to let you have a max payment of $200. That's only $12,000 a year take home pay. So that seems pretty high. They're probably going to qualify you down here at only $100 a payment a month on your credit card. The more money you make, of course, the higher the payments they'll allow, limited by this debt safety ratio. So, how are you going to go about establishing credit worthiness? You want to open a checking and savings account. This shows that you are earning and keeping income on hand. You want to never pay your bills late. Paying bills does not show up on your credit score, so just staying current is not going to help your credit score, but getting turned into collections will kill your credit score. So you want to make sure to never pay your bills late. You want to open one or two small credit cards and pay them off on time. For young people, this usually means something like a clothing or merchandise store or getting a starter credit card for your bank. Banks often offer starting credit cards, which have very low limits, but allow you to prove that you're paying off charges. And so you would be getting this not to help yourself in an emergency, but just to simply buy things and pay them off as you normally would with cash to establish creditworthiness. What types of credit can you get into? There's two types. Credit cards, we know about those. Revolving lines of credit, a little less obvious. So let's break these out. There's two types of credit cards. One are issued in-house. For example, Brooks Brothers or Lowe's, companies themselves offer credit cards. Sometimes they can only be used at the store. Sometimes they can be used broadly. Or you have the ones issued from banks. These are your Visas, your MasterCards, your American Expresses. These are some elements of all credit cards, and I'm going to go through them. You write down the definitions as I talk about them. But based on your credit history, you'll have a credit limit. So if we look at this example credit card statement, this is a Wells Fargo Visa credit card, and it has a total limit of $7,000, which means you could only charge at most $7,000. Billing cycle and grace period. These are going to be important. Billing cycle is how often your payment is due. And if we go take a look at our sample, we'll see that the billing cycle is from basically the beginning of the month to the end of the month. They probably had some days off for New Year's here, but December 2nd to January 4th. So within this billing cycle, there's usually a defined minimum payment that is due every billing cycle, and then you have until a certain date to pay that minimum payment. Grace periods, which is not specified on here, have to do with the in-between payments. So let's say you, instead of having a large balance on the card like this person has of $2,000, you have a zero balance and you buy some things. Well, you have a certain amount of days stipulated in your contract to pay those off without getting charged any interest on them. And so you'll just want to be mindful of what that grace period is. So you'll receive a bill and it would say zero balance here. Then it would show purchases made. And then you would have until a certain amount of time to pay those off to avoid interest charges on your next bill. Interest charges. Well, there's really two types of things you can do with a credit card. One is you could make purchases. And so credit cards come with that annual percentage rate. And so this one has a 14.99% rate. And you can also get cash advances, which means you could go to an ATM and withdraw cash. But you should know that you get a much worse interest rate on cash advances from your credit card. So in building credit, we really want to be thinking about just using purchases. Interest charges on purchases, like I said, if you pay them off within the grace period, you won't pay. However, cash advances begin earning interest immediately until you put that money back into the account until you pay them off. So you always have an interest charge on cash advances. Fees. This credit card has none. However, you want to be mindful of several types of fees. Some credit cards carry an annual fee that you pay for just the privilege of being able to borrow. Some have transaction fees, most specifically on cash advances. Some have balance transfer fees. So if you had another credit card and you wanted to pay that one off with this credit card, that's like a balance transfer, and they would charge you a fee for transferring that balance, something like 3% of the balance transferred. Sometimes they will let you go over your limit, but they'll charge you a fee for going over your limit. And of course, you'll be charged late fees. So if they don't receive your payment by January 29th, you pay a late fee of $35. So there's different ways to get money from you other than interest, and those would be fees. Let's take a look at a second to think about how interest is computed on credit cards. The most popular way is with the average daily balance. And what that is it takes your total balance over the period and divides by the number of days in the billing cycle. And so, not the total balance, not the total balance, but we have to apply weights to it based on the number of days. So for 5 days, I had $1,500 in the account. So I multiply that by a weight of 5 to get this value. 7 days, I had 2,332. So I multiply by 7 to get this weighted value. So these days actually provide weights to the balances. So you see the biggest number here actually corresponds to the balance that was in the account for the longest amount of time. We add those up and divide by the number of days in the billing cycle, and that gives us a weighted average balance. That is what our monthly interest rate is applied to, right? 0.015 here corresponds to some APR. You can back out what that is, and so my interest would be 36.31 here. So making payments on time is important. Since you do not have a fixed balance like a car loan, and your balance fluctuates around because you borrow with a credit card, there's not a fixed loan payment. So credit card companies establish a minimum payment. This example is a minimum 3% payment with a 15% annual interest rate based on your original balance. And so if you only made the minimum payment on these balances, what's shown here is how many years it would take you to repay it. $5,000 would take you 16.4 years to repay it at a $3,434 interest amount. So literally you're paying 68.7% of the original loan balance back as interest. We definitely want to try to pay off quicker than the minimum balance. All right, let's talk about the other types of credit that's less known. Revolving lines of credit are incredibly useful. One common one you'll see is overdraft protection, which is tied to your checking account. So basically what happens if you take out too much money from your checking account, rather than denying you those funds, the bank will pull it from your charge card. Sometimes there's a fee. Usually we don't want to be doing this too much, right? Because careful budgeting requires us to know how much cash we have on hand and not to accidentally overdraw our accounts. Unsecured credit lines are useful. Don't let the word unsecured scare you. Basically what this means, it's a no card credit card. So you have this attached to your bank account at the bank, and you can write checks against it. You can pay bills out of it. It is a ready loan. So you don't have to apply for the loan. It is a loan balance that you can borrow from just like a credit card, but you usually have more favorable interests with this unsecured personal line. This last type is very interesting. If you own a home or other big assets, sometimes you can get a secured line of credit. And so one example is a home equity line of credit. What this means is, as you recall, as you make payments on your house, the majority is interest in the beginning and very little principal, but at some point you start owning more and more of your house. You can borrow against that amount, right? You can't get it unless you sell the house, but you can tap into it with a home equity credit line. So let's say you have $100,000 paid off on your house. The bank will use that as collateral to give you a credit line at a very good rate. And the additional benefit of a home equity line is that the interest payments on a home equity loan up to $100,000 are tax deductible, just like interest payments on a mortgage. So this is very attractive if you want to say go get a car loan. You can probably beat the bank's rate and beat the dealership's rate by doing a home equity line that also provides you tax deductible interest rates. All right, guys, that's everything for this lecture. Complete the workshop. You'll be learning about 3 different people and actually figuring out their FICO scores based on their credit history, and get those submitted, and then submit Quest 4 on Friday.